The screen fades to complete darkness. Trading floor pandemonium, shouts, keyboard clacks, phone rings, cuts to dead silence. A single red number pulses ominously. SOFR, plus 17 basis points. It's Friday, January 23, 2026, 11:17 p.m. IST. While CNBC loops endless earnings calls and Fed speeches, while Twitter burns with political firestorms and memes, deep within the banking system's hidden plumbing, a single number just flashed red. The SOFR rate spiked plus 17 basis points overnight, the sharpest single-day move since the Silicon Valley Bank implosion in March 2023. To Wall Street suits, it's dismissible technical noise. To anyone who remembers late 2007, this is a five-alarm fire. This exact same signal appeared 18 months before Lehman Brothers vaporized $10 trillion in global wealth. People who ignored it back then lost everything. People who respected it built generational fortunes. Today, we're decoding exactly what this SOFR spike means, why it's flashing the identical pattern as pre-2008, why this crisis could hit even harder than 2008, and the one asset class that delivered 28% returns while stocks cratered 57%. Before we decode this plumbing breakdown, quick but critical, this channel grows fast because awake people find us. If you're one of them, hit subscribe right now and type Shadow Watcher in the comments below so I know you're part of the core community. Turn on notifications too. My community tab gets raw, unfiltered alerts when these signals spike, analysis that never makes it into polished videos. Mainstream ignores it, we don't. All right, let's dive into the plumbing crack that breaks entire economies. Think of the banking system like a massive New York apartment building housing 8 million people living comfortably until the pipes suddenly clog. The repo market is that plumbing. Every single night, banks lend each other billions in cash overnight just to make payroll the next morning. It's supposed to be boring, stable, utterly predictable. Rates stay between 4.5 and 5%. But when trust evaporates between major banks, those rates spike violently. Banks stop lending to each other entirely. They're thinking, will this counterparty even survive the next 24 hours? Suddenly, no cash flows through the entire system. ATMs freeze up nationwide. Businesses miss payroll by lunchtime. The entire economy seizes up like a catastrophic heart attack. This exact scenario played out in August 2007. The Secured Overnight Financing Rate, SOFR's direct predecessor, jumped from 5.2% to 7.8% in just days. Banks completely distrusted each other. Subprime mortgage poison was spreading silently through balance sheets across Wall Street. Trust died first, markets died second. Fast forward to January 23, 2026. The pattern mirrors exactly. SOFR leaps plus 17 basis points to 4.72% in a single night, sharpest single-day move since the March 2023 SVB implosion that wiped out $40 billion in deposits. Why now, precisely? Big banks suddenly nervous about $1.5 trillion in commercial real estate loans coming due 2026-2027. Office towers sitting at 40% vacancy rates nationwide. Regional malls shuttered. CRE has become today's subprime mortgages. No institution knows exactly who holds the worst loans, so banks pull back lending from everyone indiscriminately. This is the first domino falling, and it always falls silently at first. Most people mistakenly believe 2008 began with the Lehman Brothers collapse in September. Completely wrong. Real warning signals began August 2006, a full 24 months early. Early warnings dismissed universally as doomsaying. Housing prices only go up. Big banks totally fine. Strongest economy ever. Sound hauntingly familiar today? The actual timeline reveals undeniable truth. December 2006, yield curve inverts completely. Short-term rates exceed long-term rates. This pattern predicted every single U.S. recession past 60 years without exception. Markets ignored completely. June 2007, credit spreads widened plus 150 basis points. Bond market demands massive risk premium from corporations. Smart money exits quietly while CNBC celebrates new highs. November 2007, TED spread explodes as banks charge each other 200 beeps over treasuries. Interbank trust vanishes completely. March 2008, Bear Stearns fails spectacularly. Officials call it an isolated incident. September 2008, Lehman Brothers bankruptcy unleashes global chaos. 2026 parallels exactly. Yield curve inverted June 2024. Credit spreads widen steadily Q4 2025. HYG LQD spread plus 120 beeps. SOFR spikes right now. Phase 3 unfolding precisely on schedule. The lag always exists. Back in 2007, people insisted inversion happened, but nothing broke. They proved catastrophically wrong. Early signals always compound into inevitable reality. Current raw market data screams confirmation across multiple channels. Past 6 weeks show high yield spreads widening relentlessly. HYG LQD ETF gap hits 420 beeps, highest since November 2023 bank stress. Bond market now charges corporations double the premium versus treasuries. Major institutions smell blood and water. Bank earnings Q4 2025 revealed deeper truth in footnotes. JP Morgan and Citi boost loan loss provisions plus 35% quarter over quarter. Banks quietly reserving billions for defaults they clearly see approaching. Never makes headlines, always buried in 10K filings. Weekly jobless claims trend steadily toward 255K, first sustained rise above 250K since 2024 slowdown. Labor market always cracks first. Companies cut headcount before earnings collapse completely. These three signals, aligned perfectly now, represent siren-level warning blaring continuously. Why does 2026 threaten worse than even 2008? Derivatives explosion leads all factors. 2008 total exposure measured $600 trillion. Today, BIS data shows $712 trillion notional outstanding. Hidden leverage amplifies tiny cracks 100x instantly. Debt service math kills silently. Corporations borrowed at 3% rates, now forced to refinance at 7%. Interest payments double overnight. Zombie companies die en masse. Consumer debt peaks dangerously. $1.1 trillion credit card balances carry 21% APR. Delinquencies spike to 3.8%, highest since 2011 financial crisis. Banking parallels grow chilling. 2023 delivered fastest U.S. bank failures since 2008 itself. SVB unrealized losses, $15 billion bonds reduced to $1.8 billion market value. Regional banks nationwide hold $620 billion unrealized losses today across identical assets. Stress test failed silently long ago. Commercial real estate defaults cascade into realized losses brutally when pressure hits. No fear-mongering intended whatsoever. Pure awareness equals preparation. 2008 survivors didn't time market bottom perfectly. They simply respected early signals and positioned defensively well in advance. You're positioned early right now simply by watching. Early positioning always wins. Implement this 3-step audit framework immediately. First, audit personal exposure ruthlessly. Retirement accounts sitting 90% plus in stocks and bonds? Those identical assets crashed 57% and spiked yields plus 700 bips in 2008. Cash concentrated in single megabank? SVB depositors waited months for access. Debt becomes unmanageable if income drops even 30% temporarily. Prioritize ruthlessly. Second, implement true diversification. Own assets thriving precisely when others die completely. Physical gold delivered exactly that. Short-term treasuries worked initially. Cash in T-bills proved critical. Third, build anti-fragility systematically. Fragile systems break under stress. Anti-fragile systems strengthen from volatility. Zero consumer debt, 12 months cash reserves, 10% gold allocation equals anti-fragile. Paycheck to paycheck with maxed credit cards equals glass cannon waiting to shatter. Concrete 10K, 50K, 100K action plan starting immediately. Next 30 days maximum. 10K budget buys 1 ounce physical gold coins at $4,738 plus 6 months cash buffer. 50K budget secures 5 ounces gold at $23,690 plus cash reserves plus T-bills. 100K budget acquires 10 ounces gold at $47,380 plus diversified cash across institutions. Critical immediate step. Spread cash across 3+ banks each under 250K FDIC limit. High-yield money market funds cover 6 full months living expenses minimum. Phase 2 activates when signals worsen. Increase gold allocation to 15%. Eliminate all corporate bond exposure completely. Zero new consumer debt whatsoever, regardless of rates offered. Phase 3 triggers when TED spread breaches 100 bips. Gold rises to 25%, cash maintains 20%, short-term treasuries fill 30%. Position rides the storm out completely while hunting opportunities others miss entirely. Community Pulse Check right now proves essential. Drop these answers in comments immediately. 1. Type Shadow Watcher confirms core community status instantly. 2. 2026 or 2027 break. Vote your timeline prediction publicly. 3. Your #1 fragility reduction step taken this past year. Built cash reserve, paid off high-interest debt, started gold stack. Your single answer stops someone else's complete paralysis. We learn directly from each other. Strength multiplies collectively. Zoom out completely now. 4 macro forces converge simultaneously, creating perfect storm conditions. Debt spiral dominates. Global debt towers at $315 trillion, growing 8% annually while GDP crawls at 3%. Pure mathematical impossibility. Governments respond only with currency printing. Purchasing power dies slowly, then suddenly. Trust breakdown accelerates. BRICS nations actively de-dollarize. China-Russia combined gold reserves doubled since 2022. Global supply chains fracture completely. Everything bubble stretches terminal. Stocks trade 28x earnings. Real estate 6x median income. Interest rates normalize forces violent price adjustment inevitably. Automated fragility dominates. Algorithms control 85% trading volume. Trigger cascade sells execute instantly without pause or thought. 4 forces combined equals faster, deadlier crisis than 2008 ever imagined. System more leveraged, interconnected, automated than ever before. You're not crazy whatsoever. You're early, and early positioning always hurts temporarily. Markets mock early defensive positioning relentlessly. 2007 shorts ridiculed universally until Lehman moment arrived suddenly. Truth remains, crisis navigators prepared before obvious to everyone. You execute exactly that watching now. 3 daily signals demand monitoring without fail. 1. HY spreads, HYG LQD ETF gap. 450 BPS plus confirms panic immediately. 2. Bank loan loss provisions. Q1 2026 earnings footnotes reveal truth always. 3. Weekly jobless claims. 280K plus breaks labor market completely. All 3 signals trending wrong direction simultaneously? Evacuate defensively without hesitation. Warning screams impossible to ignore any longer. Parallels to pre-2008 period become impossible to dismiss. Final frame delivers your choice completely. Signals flash red continuously now. Awareness grants genuine power over destiny. 2008 oblivious masses crushed mercilessly. Awake minority prepared methodically and thrived spectacularly. Build your personal lifeboat before storm hits full force, not while already drowning desperately. Hit like button immediately. This helps algorithm expose identical risks to others before truly too late. Subscribe without delay. Drop Shadow Watcher in comments instantly. Community proves stronger, smarter together always. Disclaimer: purely educational and informational content only. Not financial advice whatsoever. No licensed advisor status. All investments carry serious risk of principal loss. Past performance never guarantees future results. All data current January 2026 from verified public sources exclusively. Always consult qualified fiduciary professionals before any decisions. Your personal situation remains completely unique always. The screen holds on infinite gold bars rising steadily. SOFR chart pulses urgent red warning, transforming slowly to steady green yield curve confirmation. Final text fades precisely. Early wins. Shadow watcher. Orchestral resolve swells powerfully to perfect close.